yesterday on Tuesday, February 11th, a very interesting report came out from the Federal Reserve. Household debt jumps, U.S. household debt jumps the most in 12 years, according to the Federal Reserve report. So this fits in with stagflate and tax and lie. It fits in with much higher home prices. It fits in with the mentality that a lot of Americans have again, that housing prices don't go down, thanks to the Federal Reserve put, thanks to central bank intervention, thanks to tons of Chinese hot money leaving China and ending up here in the United States buying up real estate. So a lot of U.S. consumers and homeowners, unfortunately, have this attitude again. A lot of the same mistakes are being repeated again that led up to the 2008 financial crisis, although not the crazy amounts of derivatives with housing yet. They're not doing the levels of mortgage-backed security derivatives yet, but home equity loans, it looks like, are starting to spike again. Welcome to dystopia. So let me talk more about this CNBC article. There's also a very good article by Josh Ortner, O-R-T-N-E-R. He is a pension fund manager, registered investment advisor, owner of Ortner Capital. He says his article is from Seeking Alpha from today, February 12th. The real risk of a market correction, record household debt. I'll talk about that article in a minute. First, let me talk about the CNBC article here that's summarized. So, total household debt balances rose by $601 billion last year, according to the Federal Reserve with their research. Total household debt balances surpassed $14 trillion for the first time. The level of household debt service as a percentage of disposable personal income is at all-time lows going back to 1980. Those are the key points you can see there on your screen. Article is by Jesse Pound. The full article will be in the information and description section after the video if you want to read it later. I should also mention the reason this podcast is late is because I was focusing on getting out an exclusive bonus audio podcast for my Patreon account contributors, which, in my opinion, is one of the top IPO stocks for 2020. Probably going to go IPO in 6 months or less from what it looks like. There's a lot of potential there. It is extremely speculative, but the upside is enormous, as I laid out in the article there, in the audio podcast behind the paywall. Okay, so let me talk about the article. Household debt surged in 2019, marking the biggest annual increase since just before the financial crisis, according to the New York Federal Reserve. Total household debt balances rose by $601 billion last year, topping $14 trillion for the first time, according to the report by the Fed branch. The last time the growth was that large was in 2007. Damn. When household debt rose by just over $1 trillion. So we're not back to those 2007 levels where people think that their home prices are ATMs, but we're heading there. So if home prices stay at these levels or go higher, people's mentality is going to be that home prices never go down. The people will eventually start that. Now, I know people in China have a lot of that attitude too. They have very similar attitudes. A lot of the China housing bubble has very similar attitudes to the attitudes that American real estate investors, speculative real estate investors, had in 2005, 2006, and 2007, that home prices never go down. Remember Alan Greenspan and Ben Bernanke and all the nonsense that they were talking about. And then Peter Schiff getting laughed at, predicting a housing bubble crash. Okay, back to the article. Fed economist said on the Liberty Street Economics blog that the growth was driven mainly by a large increase in mortgage debt balances, which rose $433 billion and was also the largest gain since 2007. Housing debt now accounts for $9.95 billion of the total balance. Balances for auto loans and credit cards both increased by $57 billion for the year, according to the Fed. The economist said in the blog post that credit cards have again surpassed student loans as the most common form of initial credit history among young borrowers, following several years after the crisis when student loans were higher. Quote, the data also show that transitions into delinquency among credit card borrowers have steadily risen since 2016, notably among younger borrowers. Wilbert Vanderklaw, Senior Vice President, New York Fed, said in a statement, however, even as the total amount of household debt has risen, the level of household debt service as a percentage of disposable income, personal income, is at all-time lows going back to 1980. The new report showed credit probably because interest rates have been artificially manipulated down, and that's made mortgage rates, according to this Realtor.com article, let's see here, 5-year lows? Let's see here. Homeowners are 4 times as likely to be equity rich as to be underwater, according to a new research report. And that's because the mortgage prices, I think, the borrowing for mortgages are down a lot. The interest rates to borrow for mortgage rates are 3-year lows, according to this MarketWatch article that just came out. I thought on it. I guess I didn't click on that one. Okay, here we go. Mortgage rates are 3-year lows. I thought I had this article up. And then this article just came out for MarketWatch, and then talking about refinancing. Average rate for a 30-year fixed mortgage rate now stands at 3.45%, the lowest since 2016. Thank you, Federal Reserve. Then Americans are going to start using their houses as ATMs again. Home equity loans, second mortgages, rental property. Rinse and repeat the similar stupid mistakes to 2005, 6, and 7. Also, let me get back to the article here. However, okay, the new report showed credit standards tightening for some forms of debt, even as the overall balance increased. The median credit score for newly originating borrowers for mortgages and auto loans increased slightly in the fourth quarter, according to the Fed. Mortgage originations were $752 billion in the fourth quarter, the highest quarterly rise since 2005. But this was mostly due to an increase in refinancing activity, the Fed said in a press release. That's it for the article. So, interesting things that came out in the last 3 or 4 weeks is the Discover credit card company, which is popular among college students, younger adults. They had an enormous amount of charge-off rates. The highest Q4 charge-off rate in the whole decade. So their shares crashed the most since the financial crisis, on the highest Q4 charge-off rate this decade. Zero Hedge article from January 24th, 2020. So we are starting to see too much consumer debt, which means less consumer discretionary income for some people. Now, obviously, if you've made a lot of money on stocks and bonds and real estate, you probably still have a decent amount of discretionary income. The wealth inequality gap has widened, after all. But for a lot of people, they're not doing so well because of stagflation, tax, and lie. And then what I talked about yesterday with pension funds, how central bankers have manipulated interest rates lower, so pension funds are taking more risk. All these things fit together with central banks manipulating interest rates lower and then people taking more risk, asset prices being manipulated higher with artificially cheap debt. That's why you have a lot of no-growth, dividend-paying stocks at 30 times earnings. And a lot of people are buying them. So if you want to read more about the Discover credit card charge-offs, I haven't looked at the credit card stocks in a while, so I can't tell you how well they're doing. But if Americans start using more and more equity loans, home equity loans, the credit card companies are eventually going to have some problems with that. This article is from MarketWatch from, well, still today, still February 12th for another couple seconds. More Americans feel confident about taking on debt in 2020, even as delinquencies rise. That is counterintuitive there. Transitions into delinquency among credit card borrowers have steadily risen since 2016, notably among younger borrowers. By Elizabeth Buchwald, reporter. Consumers are feeling better about taking on more debt. U.S. household debt hit $14 trillion in the fourth quarter last year. Increase of $193 billion on the previous quarter. Credit card debt rose by $46 billion. Student loan debt increased by $10 billion. Mortgage debt surged by $120 billion. The data also showed that transitions into delinquency among credit card borrowers have steadily risen since 2016, notably among younger borrowers. Americans more confident that their ability to take out credit than they were, are more confident about their ability to take out credit than they were a year ago, according to the latest survey of consumer expectations from the New York Federal Reserve. The percentage of people who found it easier to access credit this year compared to last increased by 6%. Perceived access to credit is important for banks because it could mean that fewer people apply for loans and credit cards thinking they will be denied. Consumer confidence also hit its biggest peak in 5 months. Data released by the Conference Board last month concluded people are taking out more loans. More than 20 million Americans have taken out personal loans over the last year, which is double the number of people in 2012, according to studies by the major credit bureaus. The average loan balance is $16,259. in one 2019 study. However, approximately 2.36% of loans were more than 90 days delinquent, fourth quarter last year, an increase from 2.27% previous quarter. So, more borrowing. This is the problem with digital debt-based fiat currency. This is the problem with a credit growth machine. That whenever the asset prices stay high at these levels and whenever interest rates are manipulated lower, the credit engine just keeps on chugging. It just keeps growing. And then, of course, what the Wall Street investment banks and the credit card companies have to do is figure out how to package this garbage that may default to suckers. And guess who the suckers are? The pension funds. The pension funds are the largest pool of capitals that are the most largest pool of capital that are the most suckers. That's why Danielle DiMartino Booth says the pension funds are screwed, because they have so much money to invest, they cannot meet their returns, and oftentimes when central banks manipulate interest rates lower, the risk they do take ends up blowing up in their face. RR says his pension fund's not doing that. Well, you're lucky, because there's a lot of pension funds, unfortunately, that are. Oh, okay. You're controlling your own pension. Oh, I see now. You're not okay. You didn't hire the guy from. Oh, man, I'm drawing a blank on the Wall Street movie. Big Short. You didn't hire the pension fund. You didn't hire the mortgage-backed security money manager there at the poker table that was getting ripped off. You didn't hire that guy. No, I totally blew that joke. Must be because it's after midnight and I already worked out and tired. I totally blew my Big Short joke. But if you don't know who the fool at the poker table is, then it's you. Okay, so let me talk more. So the amount of American homes that have a lot of equity has increased a lot. I have a number of articles here over the last couple weeks if you want to read those, from February 7th and February 9th. Americans 4 times more likely to be equity rich as home values increase. And this article by Josh Ortner, I think it's pretty good, so I'll read some of it. The Great Recession of 2007-2008 is historically well documented. Most market participants and investment experts did not see the great financial crisis coming. One ingredient that led to that conglomerate of a crisis was the housing market debt boom, along with the ease of credit conditions in which consumers can borrow money. Does that sound familiar? As Wall Street packaged these debt obligations in tranches and sold them to the public, the crisis deepened. Much blame is to go around for the last financial crisis, but all of us should have learned from that crisis. But this is the main lesson of history, is that most humans don't learn from history. That's the main lesson. And I'm a history major. That was my original major anyway. Well, I have 2 majors, but that was my favorite one, the one I got the fastest. Okay, back to the article. However, according to the latest report issued by the New York Federal Reserve Bank, it says otherwise about Americans learning from history. Non-housing debt is growing. The largest risk the article writer sees within this hot economy and surge in stock prices is the lack of concern for household debt. Consumers clearly haven't learned their lesson from the previous crisis, as non-housing debt grew from $2.62 trillion in the fourth quarter of 2009 to $4.2 trillion in the fourth quarter of 2019. So in 10 years, it went up almost $2 trillion. Just today, the New York Federal Reserve Bank referenced this very large increase in non-housing debt. Quote, mortgage originations, including refinances, increased significantly in the final quarter of 2019, with auto loan originations also remaining at the brisk pace seen throughout the year. Said Wilbert von der Klaw, Senior Vice President of the New York Fed. The data also shows that transitions into delinquency among credit card borrowers have steadily risen since 2016, notably among young borrowers. The credit card companies have made a lot of money. So your Capital Ones, your Visa, your MasterCard, your American Express, your Discover. I'm sure there's a couple more I can't name right now off the top of my head. These guys have been making a lot of money on this recovery for a while now. But Discover Card just had some problems. Discover tends to focus, I think, a lot more on college students. So that might be people in college. I remember when I was in college a little over 10 years ago, they were very aggressive at marketing to me. As consumers are still waiting for large increases in wages that most economists believe would happen after the financial crisis recovery, more consumers are depending on credit cards and other alternative financing to bridge the gap. The article writers argued here at their firm that the biggest unspoken risk to higher stock prices is that of non-household debt climbing along with record mortgage debt. So in his opinion, mortgage debt could threaten the U.S. economy's foundation. Housing prices are on the rise and so is mortgage debt. High owner demand and low housing supply, along with rising construction costs, are also contributing to consumers being forced to borrow more. I would also say that people are borrowing more to, again, this fits in with stagflate and tax and lie, to maintain their standard of living because their incomes are not rising. So even though their asset prices are increasing, their incomes are not increasing. Their cost of living is going up. And so for people to maintain the same standard of living, their costs are rising, their income is not rising, but their asset prices are rising. And that's why people are borrowing against the assets, because the asset prices are rising. Because they have not been able to grow their income either at their job, or they don't have a entrepreneurial venture, some type of side hustle, or some types of investments that are generating cash flow to them. This is all predicated on artificially low interest rates by central banks, manipulation, financial repression, and asset prices going up. And then people, behavior market participants, if you can call this a market anymore because it's all manipulated higher with devalued fiat currency and credit, the behavior market participants is drastically changed. You just heard Jerome Powell earlier on Wednesday talk about how if there is a recession, the Fed will increase QE even more. That's a Federal Reserve put. That's a new put. They're trying to make it abundantly clear that they will not allow a stock market crash for a long period of time. And this is why, in spite of the coronavirus, the Dow could be, let's see here, the Dow could be at 30,000 in the next couple weeks, maybe a month. The Dow's already at 29,551. And guess what? The dollar index is at 99. Dollar index is at 99.02. According to the dollar and people like Luke Groman and others, the dollar index was never going that high again. What this tells me is that the general U.S. stock market indexes are part of the risk-off strategy, very similar to 1927 to 1929, prior to the October 1929 crash. You have all this flight capital from professional money managers that normally are invested in emerging market stocks and commodity funds and oil and energy funds and base metal and commodity funds, and they are out of those because of the coronavirus. There's too much uncertainty there, and they are moving into the general U.S. stock market indexes and the dollar, and also the 10-year U.S. Treasury with the yield going down. I didn't look at the 10-year U.S. Treasury yield. Let me see if I can pull it up. Okay, where is it? Okay, the 10-year U.S. Treasury yield is back to 1.63. I think it was 1.5 something a couple days ago. Rob says he wonders if the Fed can print N95 masks. No, but apparently central bankers think that they can solve wealth inequality, think that they can solve climate change, and think that they can maybe even help with the coronavirus. Central bankers are way out of their lane. McIlvaney weekly commentary in the last day or two talked about this. Central bankers are way out of their lane. These are unelected bureaucrats, basically, that are not held in account. They're not accountable for their screw-ups. Okay, got a super chat. Australian dollars, I think, from David Bernard. Thank you very much. Omicron asks, what real estate are the Chinese buying that is so valuable? Omicron, the Chinese, especially when they buy real estate out of the United States, they view it as insurance and escape plan. So as an option to get out, and they also view buying real estate as a bank. So a lot of Chinese do not trust the Chinese banking system, so they buy real estate. They buy real estate in China, they buy real estate out of China. Buying a house, buying real estate is considered safer than putting money in a lot of Chinese banks. And there also is a ton of speculative money in Chinese real estate still. The mentality of real estate investors in China prior to the coronavirus, I don't know how it is now, but prior to the coronavirus, it was very similar to the mentality of real estate investors in the United States from 2004, 5, 6, and 7. The asset prices are growing. Rob says all he hears is the U.S. economy is growing, all is good. It's mostly about the asset prices. And now what we found out with this Treasury General account, Steve Mnuchin, President Trump and Steve Mnuchin can do their own QE. There's a flush with, $400 billion in cash in the Treasury General account. I don't think it's ever had that much before. You know, this is very similar behavior. Again, I don't want to repeat myself too much, but this is very similar behavior historically to 1927 to 1929. Every other country besides the United States back then was in a recession or depression. And guess what? All this flight capital from all those other stock markets and all those other economies all came to the U.S. And the Dow had one big last blow off top for about 2 years. Go and look at the charts. Go look up the charts from 1927 to 1929 prior to the October 1929 crash. It's playing out very similarly. And if that historical comparison is accurate, President Trump's going to end up being like Herbert Hoover. Okay, well, I think that's pretty much it for tonight. I wanted to keep it short. I know it's late. So I wanted to get this update out there. There is a lot of articles on this stuff with the amount of equity now that homeowners have. The Josh Ortner article is very good on Seeking Alpha. And also you can read the brief. The Americans are overconfident, I would say, in credit card debt, even with the defaults. This type of behavior, it occurs at market tops. It occurs when people think asset prices will keep going higher. That's when this type of behavior occurs. People should be building up savings now, not increasing debt like crazy. But it looks like we're back into the similar behavior patterns from 2005, 6, 7 with the home equity loans here in the U.S. Yeah, I may do a separate episode on China. I've been weighing that. But if I do a separate C virus episode, then the odds are that it will be 100% demonetized immediately, and then my channel could get in even worse trouble. I've already had 4 videos demonetized in the last 8 or 9 days. And I do need this extra income coming in. I mean, thankfully, my Patreons are really helping me out, so my Patreon account is very good right now, and I'm trying to reward you guys with more content. Sandstorm Gold's supposed to announce earnings, too. The earnings come out after the closing bell. If you want to take a look at that, they should be solid. I don't expect any surprises. The good thing about a cash-flowing royalty and streaming company, the business model just basically collects checks. Once the royalties and streams are producing assets, the royalty and streaming company mostly just collects checks from the royalties and streams each quarter, and then reinvest them into more growth. So the cash flows are fairly stable. Unlike a mining company where, there could be enormous problems at the mine, there's a ton of problems with a regular mining company. The royalty and streaming companies have more stable cash flows in general. Occasionally there's exceptions to that, but so Sandstorm Gold, look out. If you are a Sandstorm Gold shareholder, the earnings, the Q4 earnings and the annual report should be out soon. And the conference call, I think, is on Friday. I was actually, Max says, do an episode on side hustles. Actually, you guys, I've been trying to get this guest booked. That's a successful entrepreneur, and I think she just did a TED Talk on how she built a business from scratch up to like 6 figures. Might be larger than 6 figures. It's late. Sorry, I'm getting tongue-tied. She's a successful entrepreneur, and I've been trying to coordinate back and forth schedule with her, so I'll see if I can get that interview done. So she has done a lot of side hustling, and she hit on one of her side hustle businesses, and it became a really successful business. Oh yes, also thank you for the reminder, RR. Don't forget to hit thumbs up. So in wrapping this up, I want to thank everyone for listening. Thank you very much to my over 250 Patreon account contributors. Again, there's another podcast behind there. So if you are a Patreon account contributor and you didn't get the email notification, there's another new podcast back there. And after I've had a couple days maybe to look over the Sandstorm Gold results, I may do another audio podcast on that for Patreon account contributors. So thank you very much again to my Patreon account contributors, my dozen or so monthly PayPal contributors, and people throw me tip once in a while. I also take crypto. And with the dollar at this high, wow, the dollar at 99. If the dollar keeps going higher, I've used the analogy of a wrecking ball. I used that for the last couple of years. If the dollar keeps getting stronger to 100, 101, 102, it's going to do absolutely immense damage to the global economy, to any country or company outside the U.S. that has way too much dollar-denominated debt. It's going to be very, very bad. So I would not be shocked if the Treasury somehow, some way comes in with some type of intervention and knocks the dollar down. Because if they know this, in the Treasury Department, President Trump knows this too. Trump administration, President Trump, Treasury knows this, Federal Reserve knows this. The dollar goes on a rip-your-face-off rally upwards, it could potentially collapse everything. So hopefully that doesn't happen. Don't want everything collapsing, but we're in a crazy scenario here with the C virus and a bunch of other stuff. We're in a dystopian reality right now. Okay, bye everyone.